Hello, everyone. Welcome to November's Yankee Model Investment Club meeting. My name is Brent Gall. I'm the president of our club. I have some introductory slides we'll walk through before we get to the main topics of the meeting. Just an overall review of our club. It's a better investing model club, which means we're a fully functional investment club with real money, but we're open to observation by the public. We were formed back in 2008. We're currently 6 members that are spread across 4 different states. We went online starting in 2011, and we meet the second Monday, we meet monthly on the second Saturday at 11 a.m. Eastern. For new members, we're always looking for new members to join us. There's really no investment experience required. Any new members are mentored by an existing member if there's any questions on our analysis techniques. And there's really no limitation on where you live except for where state laws require the club to file a return. And so we can provide those particular states if you're interested in joining. All partners, you must be a member of Better Investing. You're expected to actively participate in the club's activities. This isn't a passive investment vehicle. And we expect you to make stock presentations on a rotating basis using our stock selection guide or Better Investing stock selection guide in rotation with other members. Our operations, we follow Better Investing principles. We show respect to fellow club members. We're all still learning. There's no experts among us. We perform annual audits. We file our tax returns and follow our partnership agreements and bylaws. If there's additional questions or if you're interested in joining, feel free to reach out to our secretary, Jack Finn, at the address shown. I'll put his information up at the end of the meeting in case any questions come up as we're going through our other topics. For the structure of the meeting, we follow a standard agenda. It's currently available in the handout section, and so I'll bring it up on the screen here shortly. All visitors will be muted throughout the meeting. But you can certainly type in questions using the GoToMeeting control panel, and we'll have a Q&A session at the end of the meeting where our moderator, Joe, can read out any maybe more general questions that could be helpful to the wider audience, or if anything else wasn't covered. I wanted to make an ask for ideas that the audience might have for our educational segment. Each month we do a short, maybe 5 to 10 minute presentation on a financial term or industry or analysis tool or some other topic that could be helpful to the members and the audience. The topics are really free form. They're just brainstormed by the individual member. We're not following any sort of syllabus or list of ideas given to us by Better Investing. So we're open to inspiration from members of the audience. Feel free to submit topics that you would like to see in the questions box in the GoToMeeting control panel. Can't guarantee that we will cover your topic, but it's always helpful getting additional ideas to see where people's interests lie. And then just a note on registering for the meeting. If a friend or a family member forwarded this meeting invitation to you, it probably means that we in Better Investing don't really have your contact information. So if things change or for future meetings, you won't get any sort of reminders. So if you were forwarded a meeting request, please go to the link shown. I'll put this link up again at the end of the meeting just to make sure that you are registered and so that you get automated meeting reminders before our future meetings. And then finally, a disclaimer, we are not financial advisors. None of the financial information or analysis that we will present is meant to be suggestions. Do your own research before spending your money on any sort of investment securities or investment vehicles. None of us are financial advisors or financial experts, so make sure that you make your own decisions before going forward. And with that, I will move to the agenda. where Jack will be presenting the educational segment this month, which is understanding sector diversification. So I'll hand it over to Jack.
Okay. You see my screen?
Yes.
Great. So I got interested in this when I looked around at the Fidelity tools, and I'll show you that right now. So this is what shows up in the Better Investing tools, according to Morningstar. So the Better Investing uses the Morningstar sectors. In this system, Dollar General is put into consumer defensive. So that's this purple thing down here. About 13 at this point, it was 13% of the portfolio. Our portfolio, the club's portfolio, covers 7 of the 11 sectors. The ones that are not represented are here: basic materials, energy, real estate, and utilities. If we drill down and look at the companies, there's Dollar General, and you can see that we have 4 other consumer type companies. These are consumer discretionary, and financials are over here, biotech, industrials, and so on. So when I looked at Fidelity, Fidelity has a different has a bar chart instead of a pie chart, but they use the GICS, the Global Industry Classification Standard, which is invented by S&P and Morgan Stanley. And they show consumer discretionary as being way overweight. Almost 30% of our portfolio is in that. And consumer staples over here shows 0%. So what happened to Dollar General? So we seem to be overweight, way overweight in consumer discretionary and underweight in consumer staples. Well, that led me down this rabbit hole of looking at what all the classification systems are for sectors in the economy. So this all started in 1937 with a SIC, the Standard Industrial Classification. It's been revised off and on, but it's still in use by the SEC, the Securities Exchange Commission. And so you get a thing like this. A national bank, like Bank of America, is code 6021, but a state bank is 6022. This was revised in 1997 to the North American Industry Classification System. So this is developed by a committee representing all of North America, Mexico, Canada, and the US. It's revised on a schedule every 5 years. As the economy changes, you need to make some tweaks to the system. And so you get a somewhat more stable code. So 52 always represents finance and insurance. And then to represent some subset of that, you just add on more numbers. 522110 is a bank, commercial bank. A credit union is 522130. So there's also the Industry Classification Benchmark, ICB. This was developed by FTSE and Dow Jones in 2005. FTSE now owns it outright. And its latest revision is in 2019. So their structure is different from Morningstar. They start, the top level is called an industry. So there are 11 industries, 20 supersectors, 45 sectors, and 173 subsectors. So the FTSE and Russell indexes among others, are based upon this ICB system. The GICS that Fidelity uses for their bar chart also consists of 4 levels, but they start off at sectors at the top, economic sectors, then industry groups, industries, and sub-industries. So each stock has a code to identify it at all 4 levels. And again, this was developed by Morgan Stanley and Standard & Poor's. Morningstar developed the Global Equity Classification Standard, GECS, around 2010. So I've got an article here from 2010 and a fact sheet from 2011. So this has 3 super sectors, 11 sectors, 69 industry groups, and 148 industries. So again, each stock has a code. Each stock has a code to identify it to all 4 levels. And this was revised fairly recently in 2018. So I wanted to show you this super sector business because it's actually enlightening. So they put 4 of their sectors into the cyclical super sector. 3 sectors are in defensive and 4 sectors are in sensitive. And the definition of what this means is that the cyclical super sectors are highly sensitive to the business cycle peaks and troughs. The defensive super sector are anti-cyclical stocks, and the sensitive super sector have moderate correlations to the business cycle. So this is sort of a nice overview of how these things are supposed to work. If you compare the various systems I've talked about, the ICB, the GICS, and the Morningstar GECS.
Welcome to the webinar. You have entered as an attendee in listen-only mode.
They all have 11 sectors, or industries as ICB calls it, and they're more or less named the same. So companies there may be some slight difference in which companies fall into which category, but the overall structure is about the same at this level anyway. And I think the Morningstar super sectors work in the other 2 systems as well. So getting back to the question of Dollar General, should it be in consumer staples or consumer discretionary? Well, in the pandemic, it's acted like a defensive sector stock, consumer defensive or discretion or staples. Tractor Supply, to a certain extent, has also, so it's in consumer discretionary, according to Morningstar. So companies are assigned to sectors based upon the revenues of the various things that they do. But there are plenty of companies that kind of cross sector boundaries. Apple sells music, but it also sells computers. Amazon does just about everything under the sun. Google does just about what Apple does, and some of what Amazon does. General Electric essentially covers every consumer product, and for a while they're one of the biggest financial companies in the country. Now they're called an aeronautic stock because jet engines are one of their main businesses. But they're a conglomerate that covers lots of territory. So sector definitions are only a guide. Some companies are so diverse they are practically mutual funds, and General Electric is an example. Comcast is another example, although maybe just for the telecommunications and entertainment businesses. Companies make business in new ways. So Amazon, nobody thought about doing things the way Amazon is doing it now. Apple invented a whole sub-industry of the mobile phones. And Alphabet has got these little space shot things that might take off and be entire new industries. And Facebook, I don't know what it does, but it makes lots of money doing it. So classifications of companies are always inexact and somewhat subjective. Somebody in Morningstar has to decide where to put each company. Companies change through time. So you should use sectors as a guide, but use a judgment about each company as to whether it's in fact in competition with another company you're looking at or hold. So I think that's it. That's where I got to with sectors. Any questions or comments?
Well, thank you, Jack. Like I can appreciate what you were saying about like Tractor Supply and Dollar General being maybe slightly different than, like in a pandemic situation, different than what they were considered before. I'm guessing that the folks that kind of define these sectors or that assign the sector identifiers to the different companies will probably just take probably all of 2020, right? Maybe 2021 also as kind of an exception.
Yeah.
Or did you see where they're like starting to question a Dollar General or Tractor Supply as being more what was it, defensive versus cyclical?
Yeah. So the odd thing is that Dollar General, I mean, the point is that somebody, GICS, thinks that Dollar General is a consumer cyclical, and Morningstar thinks that they're consumer defensive or staples. So they can't both be right. But I think that the idea is that, yes, Dollar General sells consumer goods. They don't necessarily sell that much food, although they've been selling more food. So food is considered a staple. Grocery stores are in staples. Selling gewgaws is not considered a staple. So that's what they thought Dollar General was. But Dollar General sort of has been changing. It's selling more food. It's doing different things. And in the pandemic, they did different things that made them more staples than maybe they were before. So it brought out to me that the whole system, the classification in general, is at some point subjective, and a decision has to be made about each company about where it fits. And it may not be a completely correct decision. So putting GE in industrials is probably a good thing, but they also sell more light bulbs than almost anybody else. So they're consumer staples or cyclical, and there's a bit of everything in the economy for that matter.
Mm-hmm. Okay, excellent. Any other comments, questions?
We did have one comment that Facebook had recently been moved to communications from where it had been previously located. I know some other companies similar to Facebook were already also moved to communications, which is a new sector.
Right. Yep.
Okay, thanks, Jack. Why don't we move on then to the review of the minutes from last meeting?
Okay. Let me get the right minutes here. Sorry. Can't see that. There, now I can see it. Okay, so last month we had 205 registered and 32 visitors. the minutes were accepted as read, and the treasurer's report as well. The positions were as shown here, and this was the sector distribution. It's basically what I showed you just a minute ago, or the sectors in terms of size. We're shooting for 25% small. We're somewhere close to 18% or so. We're not too far away from that. We want large companies to be 25%. We're more like 30-something%, so a little high and large. And medium, we're a little low again. So we really need to buy a few more, spend a little more money in small and medium-sized companies. Bill Stafford presented Floor Systems, but Bill's speakers went down after the presentation, so we couldn't hear our comments. So we still have to have a discussion with Bill about that and decide on his membership. We decided not to sell anything, but to buy Athene with our available cash. Sriram presented when to sell stocks, and the link is here to the PDF of the slideshow. Today I'll present the education segment, and Dave Sky will present the stock to study. The recording was put up on YouTube. So we did the club renewal, new business, steps to take on becoming a member, which we're going to have to rename because there were some problems with that. So I put this now in the new member packet in the public folder. Stock parents were reassigned. Stocks were reassigned to stock parents by Brent, and the members seemed to be satisfied with that. So we'll have to revisit Bill's application. Sriram is going to come up with how to sell guidelines, and I think that we're going to discuss that in December, not this month. And Joe talked about, or Brent asked Joe if we could ask for education segment ideas, and so we came up with this question using the GoToMeeting question box that Brent explained. So there was some discussion about why is Athene in the buy zone. It had some problems in Q2, and although the earnings bounced back in Q3, that still seems to be ongoing issues with its earnings and revenues. So Brent, the stock parent, thought that it was still rated to buy, and so we ended up buying some more. And that's it.
Okay, thank you. I don't know that we've used the term stock parent before, but I think it's very apt. So thanks for that addition to our lexicon. Why don't we switch to Ira for the treasurer's report?
Can I do that?
Okay,
I already made him.
come on. Okay, so here's the current holdings. We have $1,295.25 in cash, and you can see Athene. We picked up 40 shares of Athene at 37 1/4, and it's now 41.87. So that worked out. Member status. Transaction history. Fidelity dividend. Purchased Athene, and member payments are current. performance benchmark. Since inception of the club in 2008, 13.8%, right in line with Vanguard 500 at the moment. And looking a little shorter term, $24.6 versus 22.8. Investment performance. And then member performance. Looking at capital gains and losses. We have an overall capital gain, 5,566. And we don't have much to balance that out with, since Athene has come around somewhat. The only loss we have right now is in Essent Group.
That's a good problem to have.
Yep.
That's it.
Okay, thank you, Ira. I just want to, before the meeting started, I got an email from, I believe her name was Amanda. I don't know the last name, but she had some questions on forming an investment club, and one of the questions was tax calculations and accounting software. And I told her that Vivio.com basically fulfills both of those requirements. It's I believe, a subscription-based tool that links up directly with our brokerage. And Ira or Jack can speak more to, what amount of labor is involved, but I believe our transactions and contributions download automatically into our account here, and a lot of the allocations and valuations and everything are done automatically, and then Ira and Jack will do the year-end tax calculation. So it's really a one-stop shop for club management. But that's exactly what Ira just walked through. It's been very helpful. I don't think we would, I wouldn't say that we wouldn't be a club without it, but it would make being treasurer a lot more difficult, extremely more difficult. So I think it's been a very required tool for us to use.
Yep.
Okay, thank you, Ira. Why don't we move on now to the stock to study? David Sky will be presenting his stock, and David, I will make you presenter.
Awesome. Let's just show my screen.
And maybe, David, before you get started, do you want to say just a few words on maybe like your background as an investor? Are you currently a member of an investment club? How did you find this stock to study, that sort of thing?
Yeah. So just bear with me one second. Sure. So I am currently in a stock better investing stock club that through my work we meet once a month, and we've been doing this for, I don't know, maybe a year now. And we had one at my office many years ago, and that went on for about 3 to 5 years, and then it sort of, people moved on and it sort of fizzled out, and so we just started one up again. And I have my own investment portfolio, a very small one that I manage on my own, and so I'm interested in this kind of thing. Professionally, I'm an actuary by trade. I've been a regulatory actuary for about 27 years now. So I sometimes attend better investing webinars, and they do I think the quick 5 or 5 at 5 or so at the end. And someone was talking about regional banks maybe 3 to 4 months ago, and that's how I got interested in regional and this stock, kind of got me interested in looking for a regional bank, and I did a stock screen of regional banks to look for ones that had positive growth in both revenue and EPS, and that's how I landed on this. So yeah, and I think I have a lot of material, and so if you could keep me honest on time, if I get going, falling behind or whatever, could just let me know. Whenever I'm talking too fast, let me know. So this is a Essex. This is a holding company for one bank, Essex Bank, in the greater Richmond, Virginia market. It's definitely a small cap stock. It has less than $1 billion in sales and less than $1 billion market capitalization. In fact, it's only 131 million of equity. They have 24 branch offices in the greater Richmond area. They were established in 1926, traded on NASDAQ. They are just a bank. Their business is real estate loans, a little bit of construction loans, some commercial loans. They have your savings accounts, your checking accounts, and some non-interest bearing accounts. When I was looking at this, they had about $340 million in cash and about $1.2 billion in loans that they held, and offset that with about $1.4 billion in deposit accounts. The Yankee, your club utilized the template that presumes a certain amount of analyst information would be available. And I sent you guys the template filled out to the best of my ability. And I'm comfortable with you making that available on your Vivio page if you want. But for this particular stock, it was a little bit like fitting a square peg in a round hole, because there's not a lot of good analyst information for this small company. Value line, I sent you a copy of that. It doesn't look like your typical value line. It doesn't have like the analyst review. It doesn't have the 5-year projections. They do have a consensus estimate for earnings per share, which was very short term for year 2021 or 2022. And I've listed some of the value line metrics here on the slide. I don't know if that's really pertaining to the company or more to the sector. This sector, I think it's banks, is ranked 65 out of nearly 100 sectors that value line rates. If you use the SSG tool or any of the better investing tools, you can get quick links to a lot of different sites for analyst summaries. Again, there wasn't a whole lot of information there. A lot of them where they indicated, maybe a favorable buy or overweight kind of thing. There wasn't a lot of analyst information about what the analysts are thinking about earnings per share estimates or sales estimates. Morningstar, I couldn't find a Morningstar report and I know you look at that economic moat grade. So I wanted to do a little more digging or give you a little bit more information about this stock. And their company page, and feel free to interrupt me with any questions. I don't know if I'm going too fast, too slow. But anyway, I'll keep plugging along here. The company has a rich investor resource page, and one of the links there was deposit market share. And this bank is number 1 or number 2 in 3 counties that kind of surround Richmond. Those counties there. And their business in those counties make up about a third of their business, and they have about 1/3 of that market, those counties. So it seemed to me that they have a bit of a niche business, even though they're less than 2% of the banks, or have the less than 2% in the greater Richmond metropolitan statistical area. So I want to show a different page here. So another page that hang on a second, this thing is in my way. Bear with me. Why can I see this slide? Oh, there as we go. Okay, so this page was giving you see the peer analysis page from the company's website on their investment research page, and this I really enjoy this page because it compares a number of important benchmarks for banks, and I want to be talking about some of them, and I also went to a website that I learned from another presentation that I watched at Better Investing. Actually, our own Joe Farrell did it, where he talks about a government site, and I did refer to that site. But I think that for our purposes, this is pretty good for summary information. So the first line I want to show you is return on average assets. This is kind of an important ratio for understanding banks. My take when I was sort of getting into this was that you wanted to be greater than 1%. I heard Joe's presentation that he saying it should really be greater than 1.25 or 1.5. This is a very small bank, so they would have more trouble hitting that benchmark than a medium size or a larger bank that has more efficiencies of scale. Their ratio is trending up. They're beating their peers significantly on this metric, and I think that metric is up to 1.25 now. Another thing to look at is what's called the efficiency ratio. This would be their non-interest expense, like your overhead and salaries, divided by your revenue. Here, lower is better, like golf. Higher than 60% is kind of a flag. Lower than 45% is considered to be outstanding. This company is just getting down to that 60% mark. They are beating their peers though, and again, for a smaller bank, that's harder to do. The next row I was going to look at is the net interest margin, which is the ratio of the difference between your net interest income less net interest paid divided by your total loans. So here, higher is better. Essex is in the has sort of been trending down a little bit from 3.8% to 3.5%. They do, from what I read or ascertained, they do tend to be seem to be a little bit higher than average, but they are just below their peers on this metric. Loans to assets is another ratio. Here they show loans to deposits. So I went to that government site and saw that their loan to asset ratio was running about 70 to 73%. I think the target is between 60 to 80%. On that government site, their peers were right around 70%, so they're sort of beating their peers on this. I'm not really sure how loans to deposit rates, but I imagine it might be something similar, and you can see they're similarly beating their peers here. And the next one I have is net loss to your total loan. Lower would be better. I didn't. This not exactly listed here So from the government site, I have that Essex, this bank, was a low of 0 and a high of 0.12 with a range of 0.03 to 0.06 over the past several years. Their peer group has been running 0.08 to 0.1. The target is 1 or less. So, I think, they're doing pretty good here. I looked at, from this site, the non-performing assets as a ratio of assets. Here, lower is better, and Essex is beating the peer average, although they are a little bit higher than the peer median. Yeah, that's what I wanted to talk about there. The other thing I looked at was these capital ratios. I can't say that I understand them per se, but I did read in the company financials that they have more capital than what the regulatory standard is by about 5%. So I assume that tangible equity to tangible assets, or total equity to total assets, higher is better. And this company seems to be doing about in line with their peers. And then finally, I looked at these market ratios, and the price to earnings ratio is a little lower than their peers, but their price to book is a little bit higher than their peers, but still less than 1. I don't know. This company seems to be maybe a little bit more beat up than their peers. The dividend yield looked to be a little bit higher than their peers, and they just announced with their recent quarterly third quarter report that they were increasing their dividend by another penny per share. So I'm going to turn to the SSG now. Just this, you don't see this on this display, but in the printed SSG, there's no preferred stock. Their common shares, 10% are owned by insiders, 25% are owned by institutions, and there's a 1% potential dilution. So not much. And the company had authorized, pre-COVID, the company had authorized a share buyback program that they suspended once COVID hit. And then with the third quarter results, they also announced the reauthorization of their share buyback program, and to buy back 200,000 shares before the end of the year. So here's my the first part of the SSG, and I just sort of want to say, I know some people might use core SSG versus core SSG plus. This is SSG plus, and it has some features that are beneficial for analyzing banks. And that is they show this row total assets and return on assets, which you wouldn't get with just the core SSG. You also notice they threw out some results here. 2010, 2011 were a recession. I normally wouldn't throw those out just because it was a recession. But the other major thing is that a new management team took over in 2011, and the company really began a new course starting in the last quarter of 2011 moving forward. So that's why I threw out those years. I also threw out 2015. And the reason I threw out 2015, and I went back to the 10K for this, is that during the third quarter of 2015, the company terminated a shared loss agreement with the FDIC, which resulted in a one-time $13.1 million charge-off. So I think that was an unusual year. You'll see here that how do I position my mouse? That even with COVID, total assets have been increasing. Their revenues or sales have kind of held steady, even though they sort of took a cut in profit, and that cut is because they increased their margin loan losses. Not that they actually realized, but they increased that margin. The projected sales, I kept it again. You can also see that there's no detailed estimate. There's no analyst estimates for sales or EPS. I had these turned on, but you can see there's nothing out here for them. I projected sales growth consistent with the long-term trend here, and the earnings per share is kind of like the preferred procedure. I didn't exactly use a preferred procedure. I just took the ratio of what earnings per share was for these 2 years here as a ratio of sales per share, and held that as a kind of a constant, and that's what gives 78 cents. I think it's kind of like a modified preferred procedure. I want to give you another look here. Price. I have to refresh my screen. Sorry. This session timed out. Might have to log back in. Sorry. I thought everything was all set up. And,
That's Murphy's Law. It's understandable.
yeah.
Yeah, it's happened to all of us more than once.
Oh, good. You're making me feel better. Okay, so this view I want to show and value and dividends and shares. Yeah, so they had a dividend, they hadn't paid a dividend, and then they re-implemented the dividend in 2019, and that dividend is going up. I think it's now 24 cents a year. Book value has been consistently going up. I think it's over 7.25 now, and shares have been holding steady. And like I said, they've authorized to buy back 200,000 shares before the end of the year. My next view, I want to show book and debt and shares. So yeah, debt is down from where it was. It sort of did go up a skosh with COVID, but to me, their debt position is pretty strong. So I talked about my estimates. In estimating my prices at PDE ratios, I eliminated the NMFs. I don't know if they go in the calculation anyway. And for 2017, they both seemed high for both the high and the low. So I eliminated those years. That gave me an average of 15.2. Use that for my high PE. I have it as 15 with my high earnings per share forecast. That gave me a high price of 11.2. I looked at the low price using the low PDE and current earnings per share. The low price is higher than the current price. So I looked at all these other things. And the recent market low price of 4.0, when I looked at a chart, maybe the stock price hit 4.0, but it never closed before 4.46. So I chose a low price of $4.50 because really it never ended the day below that. So that's how I set those two. That gave me. I used the 25-50-25 zone. It's a little bit more conservative, and that gives me a buy range of up to 6.3. And what else do I want to say? And yeah, when I did this, I think this might not look exactly like the SSG I sent you. The price has gone up. Well, I guess here it's $6.28. So when I first started doing this, it was around $5.50. So these numbers are as new to me as they are new to you. So the upside down ratio is 3.0 to 1. I think when I sent you the SSG is 4.8 to 1. And the return is with the yield is just with the dividend yield is just north of 15%. Before I think it was about 18%. The other cool thing I learned, I didn't know you could do this, is you don't necessarily have to compare a stock with just another stock. You can actually bring in this industry average thing. So I thought that was a pretty cool thing. Now here, this is the universe of regional banks, and if you were, when I was giving you peer averages, this was what's called peer group 4, or the really small banks with between 1 billion and I think 3 billion market of assets. And here the industry average would be banks, the universe of regional banks. Still, I think that this, while sales might not be growing as fast as the regional peers, they seem to be doing a better job with earnings. Their earnings seem to be growing faster. They also seem to be more beat up with a P lower than their peers. The return on assets seems to be in line with their peers, but their return on assets has been improving, and I think it's now at 1.2. And similarly, the dividend yield shows lower than their peers, but they have increased their dividend. And the other, because I thought Liz did a great presentation a while on the PEG ratio. This is not an attractive PEG ratio. It's greater than 1. So I did make note of that. I just wanted to. Didn't think of it. So that's my presentation. I would recommend this as a stock for your consideration. And I think it was really interesting, sort of learning about a bank, analyzing bank stocks, or thinking about banks, because they don't make widgets. So it is kind of a different animal than other kinds of stock analysis. Happy to take any questions or listen to your discussion.
Okay, thank you, David. Very in depth. I must admit, I first looked at the SSG and kind of lost faith right at the visual analysis on the revenue growth chart. With a historical, revenue growth of around 2%, my interest was flagging a little bit as far as, oh man, this isn't going to be great. And also saw the huge plunges in earnings per share and pre-tax profit that you did explain, but it just is a little bit shocking when you see it on the page 1 chart. It is interesting that it's a fairly inexpensive stock, right? I think the prices have historically been bouncing between like $9 back at the beginning of the year to they're down to 5 or 6 at the moment. So a small change in stock price, like whereas we normally deal in stock prices that are $40, $60, $100, or whatever else, a dollar change here is a big percentage change for the overall stock price, which is interesting. One thing that I question, and maybe it's something that can be done readily with a small company like this, is when we set the earnings per share growth rate higher than the revenue growth rate. The rule of thumb that I've always followed or has been taught was, if your earnings per share growth rate is higher than revenue, you're basically saying that you're improving efficiencies, which is good. You're taking more of the revenue and turning it into profit, but there is always a ceiling to that. Like at some point, if you're predicting a higher earnings per share growth rate than revenue, you'll effectively try to be making, earnings out of nothing because you've surpassed your revenue growth. I don't know whether this is such a small company where there's still a lot more room to run, where they can turn, have greater efficiencies, have greater profit margin, but that is something that's I'd be wary of. And when I first did just as a different scenarios, put in a revenue growth rate of 2% and then earnings per share growth rate of 4%, it did look good. It looked, had a good upside downside ratio, good return. But when I matched them like 2% revenue growth, 2% earnings per share growth, it now falls kind of outside of the buy range as being an attractive purchase. So I would just caution, on that topic, that if we're hanging our hat on, a much more healthy earnings per share growth rate than revenue, that could be problematic if they run out of efficiencies to get. My other, like the high price and high and low PE, I think was in line with yours. I kind of discounted that one high year in 2017. So it's currently in a hold range for me just because I matched the two growth rates together. But overall, good presentation, I thought, and I'll open it up to other questions by members.
I will make one or two comments if you don't mind.
Sure.
A bank is a little bit different when it comes to growth rate of earnings per share versus the revenue side, and it has to do with a bank can continue to grow its asset size, in other words, make new loans, but those interest rates are awfully low. So what you have to, especially right now, so what you have to look at is, as an additional piece, is look to see what percentage of their loans are being done on fixed rate versus what percentage of the loans are being done on a variable rate. If interest rates ever, and I said if, not when, interest rates ever begin to rise again, they pick up an incremental extra piece of return, because typically interest rates on CDs and such are fixed, and they stay fixed until they mature. So the bank gets an extra little bit of boost. In addition, more revenue is out there in general to cover fixed costs that a bank has. So it's quite possible for them to get the earnings per share piece to grow, or the earnings piece to grow faster than the revenue piece in a rising interest rate environment. Now, it doesn't last forever, as you would indicated, but it does happen quite frequently. It's just like getting a PE expansion type of thing that goes on. It's just a little bit different for banks.
Okay, thank you.
Okay.
I was. I'm sorry. Go ahead, Jack.
No, it's Ira. Yesterday, I was listening to a BI webinar. The Ken and Mark show, basically, and they mentioned a regional bank, Axos. You show my screen here. So I did a quick SSG on it. It's a regional bank. I compared it to the community bank, and it looked a lot better. Just wanted to show that to you here. It's still in the buy zone. You look at things like return on average assets, it's much higher. Okay, in general, it beat out community bank. If you look at the SSG, it's much more up straight and parallel. and I still show it in the buy zone. Obviously, I didn't do an in-depth look like David did on his presentation here, but if we're looking at regional banks, I thought it was worth comparing. We already have, speaking of sectors, we already have 3 stocks in the financial sector, although they're different businesses than a bank, obviously. But I don't know if we want to continue adding to the financial sector at this point. Also, it's been a pretty good week for banks, and the community bank is now either at the upper end, or I have it in the hold range. So that's what I have.
And can I just say something to that, or
Sure.
yeah, I love Jack's presentation, and I did observe that 3 stocks comprising show that under one measure indicated 21% of your portfolio was in financial services, but under that other measure, GICS, one of those stocks wasn't in financial services, and only 15, and under that measure, only 15% of your holdings would be considered financial services. So I just tossed that.
Hey, Jack,
I've seen
would you
it.
send me a copy of your sector presentation, please? This is Joe.
I'm wondering about whether banks are overall are a good sector to be in, given the uncertainty. I was looking at Value Line. They didn't really have a very rosy picture to paint going forward, with mentioning about credit losses seem certain to rise. I'm quoting here from Value Line's analysis. Credit losses seem certain to rise as struggling businesses find it harder to remain viable. The government's Paycheck Protection Program likely forestalled some business failures, but borrowers in industries like restaurants and retailing have been especially hurt by the shutdowns. Some consumers might not be able to meet their loan obligations as loan forbearance programs end. Pandemic-related unemployment assistance winds down, and layoffs in some industries. So also, banks look for an increase in credit card loan losses by mid-2021. So their bottom line was basically, they said that we look for bank earnings to stage a partial recovery in 2021, with fluctuations in loan loss provisions adding some volatility to the quarterly pattern. So I guess I think it's kind of an iffy industry right now. So I would want to make sure that if we are going to do a bank, that it's going to be the best of the best. I guess that's my 2 cents.
Okay, thanks. Jack or Steve? Sounds like no
Jack, do you want
comment.
to go?
You're on mute, Jack, if you're speaking.
No, you go. I've got you've got better graphics than me.
Okay. For me, the Community Bankers Trust is in the hold range. And quite frankly, I'm still traumatized by the Bank of the Ozarks debacle. So I was looking at the stock through that lens. So that tells you I'm already biased when I'm talking about this. So here are a few things that I found about the stock that caught my eye. First thing, I happened to check the Altman Z rating, which is the guesstimate on whether the thing's going to go bankrupt or not. And at least Bank of the Ozarks has an Altman Z rating. Their Altman Z rating is 0.23. But this company doesn't even have one. It's NA, which is red flag big time. The other thing, another one that really killed me was when you look at the SSG and you look at the first quarter of 18, on mine, you see I guess like a dip, and they actually lost money in 2018 in the quarter. I think it was like -3 cents. So that's clearly lack of management. This is an established institution. There's absolutely no excuse for loss of money, especially within a 2-year window that we're in. It's just, there was no, this year you could kind of see it. Yeah, we had a pandemic, but they didn't lose money this quarter or during the March quarter, but they lost it in 18. Badness. So I don't like that. So here's kind of a new thing that I've gotten turned on to just recently. For all you Twitter aficionados, which I am one of now, I've become one of, I subscribe to somebody called Footnoted, Footnoted. And what does this woman at Footnoted do? She reads 10Qs. So all of a sudden, I've become very interested in 10Qs. And so they published their 10Q on November 6th, because all 10Qs are published on Friday nights. And I happened to read it. So here's some things that I don't like. One is they froze the company plan benefits in 2010. What does that mean, really? It means that they took away the pension. So as an investor, I like it. Morally, I don't. They also happened to close 2 branch offices in 2019. They must have been non-performing. And this was, of course, before pandemic. But here's the coup de grace. And this dovetails perfectly into what Liz's concern was that she mentioned this morning. And I'm going to read it to you verbatim. And this is quoting from the 10Q. The CARES Act and interagency statement are expected to have a material impact on the company financial statements. However, due to uncertainties regarding the economic effects of COVID-19, this impact cannot be qualified at this time. Oh, God. So that means, we're dependent on stimulus, and if we don't get it, we can't tell you how bad the bleeding's going to be. So that was it for me. That no clarity into the future, rank uncertainty. It just, as an exercise, I thought David did a fine job in presenting, but it just, especially with, there's rumors the stimulus is going to be coming before the end of the year. Oh, there's not going to be any stimulus. We have to wait till Biden gets in. I just, no. So that's kind of where I am. Thank you.
Okay, thanks, Steve. Sriram Jack.
Hi, this is Sriram. I did not do a detailed analysis on this, but I agree with Liz and Steve. I think not a good time to buy some of these financial institutions. And based on what Jack presented, we do have portfolio bias towards financial institutions already there. So unless this is something that we can replace something that we already have, or something we are expecting to do better than what we have, I would say let's hold off on this. But having said that, I think it was a very good presentation, David. I think you did a detailed analysis, and appreciate your hard work on this.
Okay. Any final comments, Jack, before we move on?
No, I was looking at the trends, and I think it was 2018 earnings per share trends. As Steve noticed, it was they actually made a loss in first quarter of 2018, I think it was. But then there were several quarters in a row in 2018, 2019 that were down, and this year I think all three quarters have been down, but we know why that is. So the Axos Bank looks better in terms of its earnings trends, and I just think it doesn't have a growth rate that's very exciting. So I just think we can find a better stock.
Okay, thanks for the input. And again, thank you, David, for the presentation. Echoing Sriram's comments, it looked very in depth, good coverage of a lot of the different factors. So thank you for presenting that. But we'll move on now to review of the current holdings. Ira, thank you for putting up our current portfolio. I'll start things off with FleetCor Technologies. New Value Line came out. They had nice things to say about the AFEX, Associated Foreign Exchange acquisition. Their third quarter results, their total revenue was down 14% to year-ago quarter. Net income was down 16%, earnings per share down 12%. But they are hoping to lower expenses by 10% compared to last year. Those results, while they are negative, I think it was understandable in a pandemic, and actually they came out better than expected for their earnings compared to industry analysts, but worse than expected for their revenue. So I currently have it in a hold at $260 per share. The buy is up to $233. For Athene, their third quarter results, they've mentioned record deposits for the second consecutive quarter. Their bottom line improved 14%, total benefits and expenses decreased 47%. So they're saying that they're doing quite well. I mentioned last month that they had attempted in a takeover bid with MassMutual to take over American Equity Insurance Life. It sounds like that takeover has been snubbed. American Equity said it was undervalued and is instead going along with, I think the name of the company is Brookfield or something. So I currently have Athene as a buy. Current price is $41. The buy is $49. And then Tractor Supply, their fourth quarter results, as to be expected, surpassed estimates. Earnings per share is up 55% from a year ago. Revenue is up 31%. They've opened 23 new stores, and they're cautious on their future outlook with the pandemic and all the unknowns, but they're hopeful that the revenue will continue growing and that they have several more new store openings that they're planning. So I currently, even though it's decreased a little bit from last month, it's at $131 currently. My buy is only up to 66, so it's well in the hold range. And that's it for me. Steve?
Sorry, I had to unmute. So Google, Alphabet, I should say, had a blowout quarter, $46.1 billion. The economy started surging again before the pandemic took hold in the second wave. So they were doing really, really well. They're in my hold range. They did get slapped with an antitrust suit by the Justice Department. Mr. Barr was kind enough to give them an antitrust suit. And they had the unmitigated temerity to pre-select, to pay Apple to have Google be the search engine of choice on iPhones. So that's roughly an $8 to $12 billion thing, and Alphabet must have upset the president somehow to sick Mr. Barr on them. But now we know that Mr. Barr is going to be out. So, and on top of that, we have the Goldilocks scenario. We're going to have gridlock Congress, which is perfect for stock markets. So, and then also with the administration, taxes aren't going to be raised as much as initially thought. So I don't think this is going to turn into a Standard Oil at all, even though we would still want to hold it in case one of the moonshots took off, like the self-driving car. When that thing hits, that's just it's going to rocket. So this is a hold. Moving on, Visa had a really good quarter. It wasn't a blowout, but it was good. It was solid. It was 5.1 billion, and they beat expectations. I'm conflicted on this because when I did the analysis last Friday, they were in the hold range, and then but that they had the old financial data, and when I pulled in the new financial data, they're in my sell range now, but I would in no way sell this. They did have a little kerfluffle when they tried to buy Plaid. What is Plaid? Plaid is a platform that anybody can go to, and if you know how to program just a tiny bit, you can use they're called APIs, and you can get into your bank account and pull the information not from the bank account's website, but your own way. It gives you the credentials to get in there and look at this. So that's the wonderful thing about Visa. They have their finger on the pulse of the competition, and they also bought somebody called Yellow Pepper that wasn't quite on the regulators' radar. So they also had a really big boost in debit cards. And I saw there was an interview with the CEO, and of course the pandemic has accelerated the cashless society by leaps and bounds. So things are going to be more and more cashless and just tap and pay and not touch anything. That's how I pay for everything now, is with my iPhone. So I don't even touch the reader. So I think this is a hold, and I also happened to check the Altman Z on this, and it's almost a 7. So it's really good, and it's towards the upper quartile of the 52-week range. Thank you.
Okay, looking at Gentex, they reported the revenue was down 1%, which was considered pretty good because the auto industry was down like 5%. Their revenue was 477 million. Their earnings per share were up 9% to 44 cents year over year. And that's one reason that gross margins have increased from 37.7 to 39.7. I have a hold on Gentex with a buy up to 24. Company's doing pretty well considering. Regeneron had a blowout quarter. Their earnings per share was 7.39, up from 5.86 year over year. The revenue was up 32% to to 2.29 billion. They've submitted phase 3 results to the FDA on their antibody treatment, so that's looking pretty favorable. Their asthma drug, Dupixent, had very good sales of 1 billion in the quarter. I have a hold on Regeneron with a buy up to 524. That's it.
Okay, thanks. Jack? You're on mute, Jack, if you're speaking.
Sorry about that. Essent, there's no news on Essent. It went up a lot this month. We're almost out of the hole. We were for a couple of days actually, but back down. There is a little news on Dollar General. They opened their 17,000th store. They're continuing to open stores like crazy. And they're going to have extended, they've announced they're going to extend hours during the holiday season. So the holidays is usually their biggest quarter anyway, and it's apparently going to be even bigger. And they also do some phone and pickup stuff like a lot of stores do now. Both of them are in the hold. Dollar General is getting, no, I guess it's still well below the, it's well above the buy. It was approaching the hold, but I mean the sell, but the sell has gone up lately, so they're a hold. Okay, that's it for me.
Okay, thank you. Liz?
Okay, so the big news with Ulta is they have announced a long-term partnership with Target that they're going to have what they call a shop-in-shop concept. So they're going to be having their kind of like a mini Ulta in the Target's stores. I have them in the hold zone. Let's see, value line lowered the timeliness to 4, but still gives them an A rating on financial strength. And they're still having some down quarter, due to the pandemic, but analysts seem to think they'll be able to recover. So I would say it's a hold and we'll hold. That's my recommendation. Middleby had their earnings report on November 5th. They actually on Monday closed in the sell zone, but now they're back into the hold zone. They, let's see, they just acquired Blue Zone, or they have a partnership with Blue Zone, which makes indoor air purification. I think it's through light technology, so there's no filters, it's filterless. And so that is, that's looking good for them, I think, in terms of air purification that kills 99.9995% of viruses for indoor dining in restaurants. And the other thing about these Blue Zone units is they can also use them not only to kill the virus and air purification in the restaurant, but they also use it as a food preserving, to preserve the longevity, because it takes out mold and ethylene gas. So it'll keep your produce fresher longer. So, so that's a new thing on the horizon for them. They had, so they've got 3 areas of business: commercial food service, which was actually down 27.4% in the last quarter. Their residential kitchen business is up 11.4%, and their food processing group was up 22.4%. So, it's still subject to, what's going to happen in terms of the pandemic. Are people going to go back to restaurants? But it seems like they are looking ahead to how can they pivot and make the most of this time. So I have them in the hold zone. And like I said, they did dip into the sell zone. So I don't know, if people are really concerned about moving forward with a company that services restaurants at this time. One thing could be to put a buy, what do they call it, a limit order or something like that, where you have it, if it hits this, I'm sorry, put it in a cell with a limit order that it, if it hits into the sell zone, then it automatically sells, or hold on to it because it's in the hold zone right now. So I don't know what you guys think about that.
I think you don't only want to do something like that if you want to get rid of it. I know that there's rules of thumb of, sell some of your high runners just to lock in the gains. But I think the danger of like an automatic sell is that you could then miss out on it running up even further. And if we think it's still a strong company, I don't know that we would want to sell any of it. But that is a good point to consider for future. Okay, thanks. Sriram?
Yes, sir. I am looking at INS and MLR, Intelligent Systems company, which is essentially a software company, technology. They essentially have processing of the financial services. That's what they're specialists in. They also have I believe it's a subsidiary called Core Card Software Inc. So both these seem to be doing better than they did, of course, from the previous quarter. I did the SSG and did not change much at all since last month. One of the things they did is during this quarter, they actually did open offices in Dubai and in India, so they seem to be expanding compared to last year. They're still down, but compared to last quarter, they're about up. Compared to last year, they're about 13 or 12% down since last year, third quarter. They had their quarterly earnings call, I believe, on the 3rd of this month. And I was pleasantly surprised. If anybody is interested, it's only like 25 minutes or so, so please listen to it. I was very impressed by the way in which the management, at least they're saying it openly in the public, they seem to be cautious in how they are growing. They anticipate the core card to be expanding much more than they have. I think they have a contract with Amex. They're working on it. But the way in which they're saying the CEO was saying, I'm going to take only one major task at a time. So that way I will have the control of what we are doing. I thought that was a good management strategy, especially there's a lot of potential for this company to grow. Again, the current price is at $36.35. We bought it at $33.06 or 7 or something like that. $33.07, and now it's $36.35. At this point, I would recommend just not do anything. Just keep it hold and keep it observing as they build. The second stock I'm keeping an eye on is that Miller Industries. If you remember, that was one of the most recent additions to our portfolio. I think we added in July a little bit, August a little bit, and I think bulk of it, about 150 shares, we purchased in September. Since then, it's been up and down. Again, my latest SSG did not make any much of a change. We bought this at about $30.85, and current price is about $32.50. They also had their quarterly earnings call on 5th of November. Again, they are down about 13% since their third quarter 2019, obviously because the main business they are involved in selling the trucks. They're not selling much right now, but they're hopeful the market will pick up as the need for big trucks and vehicles be back on the road. So they're anticipating sales in the fourth quarter. But again, they did give a same dividend as before the previous 2 quarters, about 18 cents per share. In the big picture, again, we don't know how things will be in the next quarter or next 2 quarters based on what's happening in the COVID. But in the big picture, again, this is also a family-run, well-run business. Management seems to be cautious, and we will see what happens. Again, this also at this point, I would recommend holding, not doing anything with this stock either.
Okay.
Any questions?
Nope. Okay, thank you. Jack, any updates on watch list?
The watch list is no buys. The hold for DR Horton and Five Below and Viva is still in the sell zone.
Okay. No help there. All right. I guess any motions or suggestions for buy or sell? I tried to make a note of any stocks that I heard that were in the buy zone, and I think I only heard like Athene, which is what I was tracking, but I hate to add more money to that because that's near the top. I was hoping Miller was going to be in the buy range, but it doesn't sound like it.
Yeah, it's the lowest percentage we have. It's 3.8% of our portfolio. But Sriram, did you say it's not in the buy zone, or that you'd rather just hold it?
No, it's very just outside of the buy range.
Okay.
Yeah, I think let's hold it. I again, there is some uncertainty, but at this point, I think it makes sense to hold.
Ira, is Regeneron in the buy? Do you have Regeneron in the buy?
No, I have it as a buy up to 524. It's at 566. It's also 8.5% of our holdings.
Yeah, it's pretty big.
I wouldn't want to increase it. We have a dilemma here.
Well, we could just sit on the cash until next month. I usually don't like doing that, but if there's no real good deals.
What about intelligent systems?
It sounds like that was in a hold also.
Yeah, but we're not too far from our buy-in, right? Because our cost basis is 33, and it's at 36. So that's pretty close.
Yeah. But I mean, can we put a limit order? Maybe if it comes down to for both Miller and Intelligent Systems. I mean, they are just outside of the buy range.
Yep.
Well, if they're both equal, I would say, yeah, maybe a limit order for Miller just to get the, that 3% of the portfolio up a little bit.
So Sriram, what
is
you
your
have is the buy price, buy below price?
Just below 32.
$32. Okay.
for Miller?
Yes, for Miller.
It's only $32.50 now, so it's very close.
Yes.
How about, limit order for $32 max for Miller?
I go with that.
Okay.
Maybe 40 or 50 shares. I don't know how much money we have.
Yeah, 1,295.
Yeah.
Yeah. So I think it'll be close to 40 shares. We have about 203 shares of Miller.
Okay.
We can make it to 240 or something like that. That's my recommendation if it's under 32.
Okay.
And that'll move the needle a little bit. That'll only bring us up to what, like 4%, 4.5% or so, but better than nothing. Liz, Ira, Steve, do you have opinions on that proposal?
I agree with it.
Yeah, I would go for that.
Yeah, and I really like how the thought process is to put a limit order in at 32. I love that. So I'm all for that. That's good.
Okay, sounds good. Jack, are you executing this trade?
Yeah, I'll do it. We have about 0.7% cash, so we'd go up to 3.5 or something. I'm sorry, 4.5%.
4.5, yeah.
Yeah.
Gotcha. Okay, any other motions for buy or sell? Nope, sounds good. Moving on then. For business, just wanted to go over the steps to take on becoming a member sheet. I'll take back presenter rights here. This is just a little info packet that Jack put together. You should see it now. It was a little bit confusing because this is really kind of just the introductory info sheet, right? Right, Jack? And then
Yes.
the other one, steps to becoming a member, like after you're voted in, that's the other handout. So maybe we want to change the title of this to be like, Yankee Model Investment Club, like fact sheet or info sheet or introduction or something like that. But the main content that I changed was it's highlighted in yellow. I'll remove the highlights for the official copy, but we mentioned, actually we mentioned in the introduction that we don't accept members from certain states, but I've just highlighted them here just to be absolutely clear. Added in, that you need to register for upcoming meetings, so have the link there. And then I think we reworded this for the presenting the stock selection guide. So does anyone have any concerns about these changes or any other additional information to add or changes we need to make?
I think this looks good.
Okay. Any comments on renaming this to be something a little bit more distinct than the other one?
Can we say information for prospective members?
That sounds good to me.
Sounds good. Okay. I'll reword it and I'll send the draft to you, Jack, and then if you want to clean it up, and then we can post it to the Vivio site.
Okay.
Okay. Let's see. Then now moving on to the rest of the agenda, new business. So after the meeting adjourns, we'll discuss David Sky application. The other new business was just the bond insurance. I sent the PDF of the application to the members by email. I think we had discussed this in a previous meeting, but I don't know that we had the official application. I'll open it up for discussion. This is basically insurance for our current holdings. I think based on a percentage of the valuation of our portfolio. Anyone have any topics or I'm sorry, any opinions on whether this would be worthwhile?
Only Jack and I can steal money, and I'm watching him, and he's watching me.
Yeah, we're all watching you guys.
The read-only people could watch both of us.
Yeah.
Yes.
Mhm.
Okay, that's what I figured. I just wanted to open it up again because I had the form. But we'll call it as not needed, so that's good. Okay, and then looking forward, Ira, I have you down for stocks to study in December. We'll take a break from the educational segment just so I can realign assignments. And then January I have Jack and then Ira for educational segment. And then February I do stock, and then Liz I have you for educational segment. And I left March. We mentioned previously that we were going to limit new candidates to once per quarter. So I have kind of a placeholder here for them. We can discuss further, in upcoming months. But Jack, we may need to. I think you have some potential candidates. We can talk to them about.
I have a name for you to put there instead of a placeholder. Sharon Watkins is the next in line, I think.
Okay. All right, I can pencil her in for March then. Okay. Any other business items we need to discuss?
Brent, I have a
We
question.
have 3 requests for education segments.
Oh, good.
One being preferred procedure. One on how do you find small and medium-sized companies to review, and how to use Better Investing's stock screener. I can offer a suggestion, and that would be if you go to YouTube and look for Better Investing or Manifest Investing, there was a presentation done by the Mid-Michigan chapter this week that covered all 3 of those topics over 2 presentations under what they call their COVID, I've forgotten the exact title, COVID something.
The Mid-Michigan
It escapes me at the moment. Let me see if I can find. Yeah, there we go. COVID cancellation conference. There's a presentation that was done by a fellow by the name of Cy Lynch out of Atlanta, and I think he did that on Thursday or Friday that covered those topics. So that would be a place for folks to go find information in the meantime. Also, I added the sector diversification presentation that Jack did to the handouts. You can find it in the handout section of your control panel.
I
That's
put
all.
lots of links to source material that I used.
Say that again.
I put in links to source material that I use to prepare that.
Okay. And for those that are interested in reviewing other presentations that have been done by this model club, you can go also to YouTube to a site named John Finn, and you will find the last 8 meetings of this model club posted there as YouTube presentations.
Okay, thank you. Jack, did you have another topic you were going to bring up?
Yeah, we still need to do something with Bill Stafford's application. Have you heard from him about his technical difficulties?
I think he emailed me after the previous meeting and said he was effectively retracting that application pending him updating some of his computer hardware.
Okay.
So I think once he does that, he'll let us know, either myself or you, Jack, or the team, and we can reassess when that date comes.
Okay.
Okay. Well, thank you, everyone. I'll put the next meeting is again second Saturday of December 12th, 11 a.m. Eastern. There's the link to make sure that you are registered for the automatic emails and reminders for joining the meeting. If there's any questions that we didn't cover, or if you're interested in joining us, contact Jack at his email address there, and we hope to see you at the next meeting. So thanks for attending. And then so the members will stay on for the discussion, and then we'll end the presentation for the attendees. Thanks, everyone.